On Brexit, because of Brexit, very honestly, no. I don't think Brexit has any impact, direct or indirect. The direct impact on India is very, very limited. Indirect impact may be there. Indirect impact may be there largely by virtue of currency. The pound we've seen has weakened a lot. Whenever there is any kind of uncertainty in global markets, anytime, whether it is Brexit, whether it was Lehman, whether it was problems in Europe, whatever it is, you will always find that there is a strengthening of the US dollar. So people have a risk-off attitude, and everyone believes that US is the safest haven, money goes back into the US. So that contagion effect, which may be in the form of a currency weakness or in the form of a stock market weakness, is not something which we can rule out. That may have some impact on businesses, but very, very limited in my view. So direct impact, zero. Indirect impact may be there. Ironically, a few years ago, I think about 5 years ago, the US was downgraded, if you recall.
Yes.
Now, when the US gets downgraded, you would believe that people would move their money out of the US, out of the dollar regime. But in actual practice, people moved money out of emerging markets back into the US. So that's the way it works. Anytime there is any weakness in the world, money goes back to the US. So you will see the US dollar strengthening, you will see the Japanese yen strengthening, and you will see gold strengthening.
Now, typically every time when we've seen a risk-on trade, the challenge with the risk-on trade is that it creates a lot of short-term imbalances. We tend to see a lot of dislocation in asset prices. Now, frankly, if I look at the post-Brexit scenario, we saw a knee-jerk reaction in financial markets on Friday. Banks or UK-based banks, they fell. Some of them, they fell because of valid reasons. But there is no panic. You cannot smell or feel that this is a repeat of 2008 financial crisis, like what happened post-Lehman or what happened post-Bear Stearns.
I agree with you, completely agree with you. And I think if you ask me personally, a bigger risk to my mind would be something happening in China rather than something happening in the European region in terms of its impact on India. Why I'm saying this is that my worry would be that if for whatever reason, China's done a lot of things we know. The domestic economy they tried to strengthen, it's not really succeeded in a big way. Now if they fall back on exports, and if they believe that exports is really the way to go, then is it possible that they can devalue their currency? And if they devalue their currency in a significant manner, then the impact that would have on India could be humongous. So to me, that would be a bigger risk on India than anything happening in Britain or anything happening in the Euro region.
Global growth has been a concern. Global growth will be a concern. Central bankers are printing money. And why I'm talking about global growth is because if I look at the export data is contracting. Is there a case that there would be pressure on export, which will have a pressure on demand, which will have a pressure on housing demand? Housing companies are not the first derivative, they're the second or the third derivative. But indirectly, when the positioning changes, could that have an impact on local demand?
See, when you look at demand for housing, the demand is largely for middle-income residential housing. We take our own example. Our average loan amount for new loans we gave in the quarter ended March 2016 was 25 lakhs. So if we are talking of a 25 lakh rupee loan, we are talking of a property value of around say 40-45 lakhs, which is typical middle-income housing. Now, if you take a city like Mumbai you can break up in two parts. You take the Mumbai which is south of, let's say, Borivali, and you take Mumbai which is north of Borivali. Now, the growth is all coming in the outskirts of the cities. Growth is coming in tier 2, tier 3 towns. Growth is coming in the outskirts of all the big cities, be it Mumbai, be it Bangalore, be it Chennai, be it Delhi, be it wherever, NCR, wherever. So that kind of market, the middle income market, the lower income market, that demand is insatiable in my view for a long time to come. For a very simple reason which I probably explained on your channel, and I probably told you, that the average age of a first-time home buyer in India is about 38 years. First-time home buyer is 38 years. And 65% of India's population is below 35 years of age. So all these people will progressively over the next few years need housing and therefore housing loans. So on a structural basis, demand for housing will always be there. The critical thing is jobs. It's not job creation that is as important. Of course, that is important in the long term. But for us in the housing business, more important is job stability. So people start perceiving that their jobs are at risk, that they may lose their jobs. In that kind of an environment, people will become a lot more cautious, a lot more, Indians by nature are very conservative with their spending. They will fall back on spending money. But other than job losses or serious job losses in the system, my sense is that the demand for middle income housing in India is very, very strong.
The general view, and this again has been a debatable view, that the HFC market is getting more competitive. Everybody wants to be there, from NBFCs to private banks and now PSU banks. You're growing, but do you think now at a large base the growth numbers would be a challenge purely because of growth, not because of opportunity?
I would say the base is large, you're absolutely right. Competition for us continues to be the banks and to some extent LIC Housing. So if we were to look at our 4 largest competitors, they would be in that order: State Bank of India, ICICI, LIC and Axis Bank. These would be our 4 large competitors. And that trend has remained same over the last probably 5 years or more. So it's not the new HFCs who are coming into the market or the NBFCs who are coming to the market who are really competing in a big way with us. If you look at the weighted average interest rate that many of the NBFCs stroke some of the newer HFIs have in the balance sheet, the weighted average lending rate is much higher than us. So they are catering to a different category of customers, not the kind of customers who we generally cater to. So they are not serious competitors from our perspective. It still continues to be the 4 large ones. But you're right, the base is larger. On a larger base, the growth obviously is something we have to keep monitoring. Fortunately, the demand for housing continues to remain strong. Disbursements continue to remain strong. Interest rates coming down typically results in a reduction in the term of the loan, a duration of a loan, because every loan that we give is repayable through equated monthly installments. Now, the installment is fixed at the beginning of the term, at the time the loan is taken. And the installment is broken up in 2 components, interest and principal. So you calculate interest at the beginning of the month by applying the applicable interest rate on the loan outstanding at that month. So when interest rates come down, the interest component of the EMI reduces. The EMI remains the same, and therefore the principal amortization increases.
So in a falling interest rate curve,
so in a falling interest rate, the loan gets paid back faster. Now, in a sense, from a risk perspective, that is great, because the principles of lending, or the philosophy, or what we learned when you started the business of banking, is the faster the money comes back, the money you lend, faster it comes back, the better it is. But it also means lower on-balance sheet loan book growth.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.